If you've spent any time staring at raw price charts, you know the feeling. You draw your trend lines, wait for a breakout, and then watch as the market moves in complete defiance of your technical setup. It feels like total chaos. The problem is that candlestick patterns are only the symptoms of market movement. To find actual sustained direction, you have to look at the cause, the massive underlying forces pushing that money around in the first place. The Canadian dollar against the Japanese yen offers a specific look at a market where those primary drivers are unusually visible. This pair reacts to two distinct engines. The first is the global energy market, specifically the daily price of crude oil. The second is the interest rate gap between international central banks. When you view CAD JPY through the collision of these two specific global engines, price movements that once seemed random begin to follow a decipherable trajectory. Let's look at the first force. The Canadian economy is heavily tied to the earth. They are a massive net exporter of crude oil, shipping millions of barrels across the globe every single day. When oil prices go up, the math shifts. Foreign buyers must convert their local currency into Canadian dollars to pay for it. This inward capital creates a surplus. It boosts Canada's trade balance, strengthens GDP, and signals the economy is flush with cash. For a trader, this translates into a highly reliable signal. When you see a sustained rally in crude oil prices, you are looking at a direct tailwind for the Canadian dollar. You cannot analyze the strength of the loonie without knowing the price of a barrel of oil. The two are permanently linked. On the other side of this pair is Japan. For decades, the Bank of Japan has maintained a strict monetary policy of keeping interest rates at near zero, or even in negative territory to stimulate domestic growth. This policy makes the yen incredibly cheap, fueling the carry trade. Investors borrow yen at 0%, convert it, and buy higher-yielding foreign assets, pocketing the difference. Constantly selling borrowed yen to buy these assets puts relentless downward pressure on Japan's currency. This constant selling establishes the yen as the world's premier funding currency. It is the cheap capital that institutional investors use to shop elsewhere. When the yen props against the Canadian dollar, it rarely means the Japanese economy is collapsing. It simply means global capital is chasing a better yield across the Pacific. Now we put the pieces together. The highest probability setups happen when these two distinct engines align perfectly. Imagine a scenario where global oil demand surges, sending WTI crude into a steep uptrend. The Canadian dollar gets an immediate revenue boost. Simultaneously, the Bank of Canada raises interest rates to fight inflation, while the Bank of Japan refuses to touch their 0% policy. The yield gap between the two countries widens. A widening interest rate gap aggressively drains capital from Japan, funneling it straight into oil-rich Canada. Conversely, if oil prices crash the same day the Bank of Japan hints at a rate hike, the pair plummets as the carry trade unwinds and revenue evaporates. Waiting for this specific dual-engine confirmation provides a degree of conviction that technical analysis alone rarely achieves. To actually trade this, you need to step back from the 5-minute candlestick charts and build a macroeconomic dashboard. This chart shows the CAD JPY price action, with the WTI crude line overlaid directly on top. When you view them together, you can easily spot live divergences, moments where the price of oil confirms a breakout or warns you of a fakeout. Next to that, set up a live tracker for the spread between the Canadian and Japanese 2-year government bond yields. This tracks the day-to-day strength of the carry trade, but you have to respect the risks. If a massive geopolitical shock hits the news, logic gets thrown out. Panicked investors will trigger a flight to safety, aggressively buying back the yen to cover their loans, regardless of what oil or interest rates are doing. Because the forces pushing this pair are so massive, sudden correlation breakdowns are destructive. Strict position sizing and hard stop losses are mandatory. Mastering the CAD JPY pair requires you to abandon the mindset of a day trader scalping pennies and adopt the mindset of a macro strategist writing multi-week global trends. Open your FXNX terminal, load up the CAD JPY pair, and start tracking those oil trends and central bank yield spreads today. By mastering the oil and carry trade synergy, you move away from chasing price momentum and start positioning yourself alongside the same global cash flows that move the market.